Good morning and welcome back. It's the 28th of October and it's a Friday, which means later today our podcast will be released. So please do subscribe to our YouTube channel to ensure that you're notified of this. 4 pieces of positive and important information and data prints which I want to share with you this morning. The first, after 2 consecutive quarters of negative economic growth in the US, which indicates a technical recession, economic growth was positive for the third quarter, beating analyst expectations at 2.6%. New orders for goods manufactured in the US rose for the second month in a row, up 0.4%. The delivery of the European Central Bank's decision to raise interest rates by 0.75% was in line with the market expectations and therefore well digested by the markets. And data released by the Confederation of British Industry reflected strength in the consumer, with retail sales in the UK coming in ahead of expectations, showing a positive expansion there. The response from bond markets was positive. We saw yields move lower. However, stocks on a global basis moderated overnight. This was primarily led by the US and the earnings report from Amazon, which softened their expectations for retail spending in the lead up to Christmas. In terms of adding further detail to some of those important points, US economic growth. So the US economy expanded by 2.6% in the third quarter after contracting through the first half of the year. The key drivers here were strength in exports and a rise in investment by business. In terms of the exports, they were in part driven by the sale of oil, given the supply constraints as a result of the conflict between Russia and Ukraine. But consumer spending is also another factor which I wanted to bring out of that data print. Consumer spending growth was positive at 1.4%, but it was showing signs of softening. Now, this is quite an important aspect because at this point in time, that's exactly what the Federal Reserve are seeking to achieve. They're seeking to cool demand in order to bring inflation back to that 2 to 3% inflation target. To evolve the picture on inflation, later today we'll receive the personal consumption expenditure data from the US. And this is the Federal Reserve's preferred measure of inflation. Preliminary data which came out yesterday suggested that we may see signs of a slight softening. However, we'll provide you with a full update on this here on Morning Markets on Monday. In terms of the European Central Bank yesterday, the European Central Bank delivered their second interest rate hike of 0.75%, taking interest rates to 2%. They haven't been at that level for 13 years at this point in time. This was in line with the expectations. They also continued to reinvest the proceeds of maturing bonds, so they're not moving to the quantitative tightening regime which we're seeing across here in the UK and in the US. The central bank also noted that the scale and the pace of future rises would be very much dependent upon the outlook on inflation, and they'll provide some time to see the effects of previous interest rate hikes before they tighten further. Christine Lagarde refused to be pinned down in terms of where interest rates are expected to get to and changed the language in terms of the pace of those interest rate hikes. As a result of that, yields pulled in, so yields moved lower, so interest rate expectations moderated. However, if we look in the markets at this point in time, the market's currently expecting interest rates in Europe to be around 2.5% 1 year from now. This really builds on the theme which was laid out by Ben Broadbent at the Bank of England last week, which set to moderate market expectations of the pace and the level interest rate hikes we're seeking to get to. And we've seen this sort of conversation evolve throughout Europe. Hence, bond yields moved lower, not just in Europe, but across the UK. Thank you for watching.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.